It is Friday, February 1st, 2019. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was a very fun get your ass kicked at Jiu-Jitsu Friday today. We were doing a little bit of collar chokes. And I got to tell you, man, I really like collar chokes. There's a couple of them that I have a lot of trouble with, though. The cross collar choke. We went over that today, and for some reason, I have a lot of trouble turning my wrists out in the right way. You know, for some reason, I don't know what it is. If I get my hand deep enough in there, I have a lot of trouble turning it. You know. But anyway, it was a lot of fun. We covered it from multiple angles. And the last angle that we covered it by, I actually liked the most. Just because it seemed like I was able to keep my opponent in really tight, you know? And it was cool. I don't know how to explain it. Like the grip on it where we're pulling him down and whatnot. The grip on it, instead of just reaching across and grabbing up over their neck, is you do a whizzer around the back of their arm. You know, you get that overhook on the arm, and then you reach over and you grab the opposite lapel. And then after that, it's just getting your hand on their shoulder and bringing it in for the choke. But yeah, that's one that, if I had that one etched in my memory, I'd have fucking tapped everyone with that one by now. I mean, because, like, seriously, I can't tell you how many times I've gotten in that position where I've reached through and I've got that lapel, I've got the whizzer, there's nowhere they can go. They don't have a hand to defend. If I put my other hand up there, you know, if I can get my other hand up there, they're fucked. You know? You know, if I brought it around over my head and onto the other side, they'd be completely fucked. So, yeah, you know, I really like that one. It seems pretty fucking sneaky, and one of these days I think I might actually catch somebody in one of those. You know, it's one of those things where with my body type, there's certain moves that are a lot tougher for me to do. You know, I'm not as flexible as I used to be, and plus got a little bit of muscle, a little bit of fat on me, and makes some of those movements a little tougher. But nonetheless, I like, you know, with like a triangle. Triangles are kind of tough for me. I've gotten them before. I almost got one today, but I didn't have them actually secured at the elbow, and that definitely would have helped out in that particular situation. And he was able to pull the hand through, which is bad. Don't want that to happen. But yeah, it was all around. I really like the format of the class. Because I feel like conceptually, at least, I retained a little bit more. We did something a little bit different today, where we warmed up and then we rolled. You know, directly after the warm up, we got a nice, I think it was a total of like 10-15 minutes of good rolling in between multiple partners and multiple scenarios and whatnot. And that was good, even though I was really sore. I'm still really sore from all the people that beat up on me on Tuesday, all the white belts. I know that some of you are very energetic and really put it to my joints. Anyway, so yeah, I'm still recovering from that one. And I managed to limp through the rest of the week with... I got in a class on Wednesday and then a class today. I took yesterday off. I mean, normally I take Tuesday and Thursday off, but I've been trying to get those additional days in and really push the level of my jiu-jitsu up, you know. And I feel like it's working to some extent. I mean, I rolled with a really big guy today, and I was a little better off than I recall having been with him, but he's one of those guys that I definitely feel like he wore a white belt somewhere else and might have actually gotten a higher rank, because he's very athletic. He does not look athletic at all. He does not look athletic at all. You notice I'm not even mentioning his name? That's because I want him to catch you. I mean, I watched him roll against a guy who regularly competes in paid events. I don't know if they actually pay him. Maybe if he wins or something, but I mean, like, they're events that, like, people pay to go to. He's an excellent jiu-jitsu 10th planet black belt, and that's Mike DeWitt. I can name him because he's not actually in our gym, but yeah, good old double stuff. It'd kill you. I had the honor of rolling with him one time, and I'm not blowing smoke up anybody's ass here. That guy is really fucking good. But I watched one of the gentlemen from our gym roll with him, and he's a white belt. And it was during the ultimate phase of a tournament. And even though Mike won, it was not an instantaneous win. He actually had to work for it just a teeny tiny bit, just a little effort. I know for Mike in particular, it probably wasn't like anywhere near like 50-60%, but nonetheless, it wasn't a pushover contest. He actually had to work for it a little bit. But yeah, it was a lot of fun rolling with him, but I always get the feeling like he's being easy on me because he knows I'm a little older. He's just being respectful of elders and all that. But if we were to be rolling in like open mat or whatever, that I'm sure he'd just like execute me every time. Anyway, let's go ahead and get into some music. And as far as like what to start off with, I've been feeling the need for some Death Clock. And you know, it's funny because for the longest time I didn't actually think they were a real band. You know, I thought they just did the music for the show and whatnot, and you know, just like cobbled it together or whatever with some neat audio software. But no, they are an actual band. And as a matter of fact, Gene Hoglan, one of my favorite drummers, is in there. And let's see if we can find it. Metalocalypse. There we go. Awaken by Metalocalypse Death Clock. First dance here on Coin Metal. And that was Within the Ruins. Elite. Yes. And so, speaking of Elite, we're going to start right off with articles. I actually do have several articles that I intended on covering at some point or another. And, yeah. Oh, shit. You know, I was tempted to open it up with the previous one, but I'm going to open it up with this one, because I think at least the title is funnier. And this picture always reminds me of Pinky and the Brain. I don't know if you're familiar with who Vitalik Buterin is. I'm sure most of you if you're listening to the show, chances are you know who Vitalik Buterin is. Anyway, there's this picture of him, and he's obviously up on a stage somewhere because of the lighting. And it always reminds me of the Brain from Pinky and the Brain. Anyway. So this is on livebitcoinnews.com. Vitalik Buterin says IBM is, quote, missing the point about blockchain. And he used it in a mono term, so, you know, instead of blockchains, as there are multiple. Anyway, this is by Jeffrey Francis. It was authored December 1st, 2019 at 10 a.m. Oh, that's interesting. I'm amazed this actually got by my notice. I don't know, I might have actually read it. I'll be able to tell if I read it anytime recently. Ethereum co-founder Vitalik Buterin has a lot to say about blockchain, as well as believing IBM is, quote, missing the point. In the age of political correctness, it's refreshing when someone actually speaks their mind. Vitalik Buterin has no problem expressing his opinions, such as calling out Craig Wright. Quartz spoke to Buterin at DevCon, the Ethereum developer conference, where he expressed quite a few views on the current and future state of blockchain technology. Vitalik Buterin throws some shade at IBM. One interesting facet of the interview was how some entities were using Ethereum and blockchain to generate hype for projects that could more easily be done through alternative means, such as a database. Buterin thinks such projects can be undertaken just for marketing hype, but he also says that even if the project is done in earnest, deciding to use blockchains instead of other alternatives can lead to a lot of wasted time. I happen to agree with him there. He notes one particular project he considers a waste of time is, quote, IBM's blockchain. He says, I don't understand IBM's corporate blockchain. I deeply but what? Oh, wait a minute. I read that sentence wrong here. I don't understand this IBM corporate blockchain deeply. But the detail that jumped out at me is they're saying, quote, hey, we own all the IP, and this is basically our platform, and you're getting on it. And, like, that's totally not the point. It's no secret that Buterin is not a fan of centralization. It was just a few months ago where he publicly said that, quote, centralized exchanges should, quote, burn in hell. However, he does go on to say that IBM's food blockchain might have some benefit. He notes, quote, the potential value of tracking food on a blockchain is that you'd get QR codes stamped on the food at every step along the way, and you as a customer can scan the code and get confirmation about here is where the stuff came from. Like, I can check if it compiles with my own moral it complies with my own moral values or standards for quality and so forth. There is definitely something there, but whether or not any of the actors there are doing it remotely correctly, I'm much less sure. Good use cases for blockchains. Vitalik Buterin also expressed his view that not every industry would benefit from blockchain technology. He does say that a few particular industries are the most viable when it comes to blockchain technology. These industries should come as no surprise, Buterin says. Cryptocurrencies and making international payments easier. All of the other ideas, whether we're talking about products or the self-sovereign identity stuff, that's clearly something that still needs much more time to be worked out before we can see whether it makes sense at scale. And my note on all those decentralized identification things, the whole point of getting into cryptocurrencies, as far as I'm concerned, was to avoid associating my identity with my transactions. Anyway, continuing on. Going beyond money. I think the value is that you create a token and you immediately have access to wallets, multi-signature wallets, decentralized exchanges, and just using it as collateral, all of this infrastructure that you wouldn't have access to if you just created a currency and tried launching it off on your own server. I feel like actual utilities in the space are going to start getting closer to things that are more purely digital. Currently, Buterin's favorite non-financial application of blockchain technology is authenticating university degrees. He loves the idea of having your educational degree digitally signed on the blockchain. He notes the additional benefit of if a college revokes your degree, that information will also be stored on the blockchain and accessible to all. That's kind of interesting. That was the end of the article there. Kind of interesting. I don't know that I would I would say that he's 100% correct on that stuff. The big problem that I see is that a lot of people want to use the internet as some sort of track every fucking thing you do kind of platform. And cryptocurrencies, being what and as they are, kind of lend themselves to this. That every transaction would be recorded. Now, whether or not your identity is associated with it, or any identifying feature of you, yourself, your person, your location on the planet, any of that. Honestly, I believe these should remain two separate elements. We've seen where the association of your identification and your funds on, say, a cryptocurrency exchange just means that your wallet gets evacuated that much quicker, and they don't actually have to hack the entire exchange to get it. They just call up a few cell phone providers and try and do a little phishing experiment, a little social engineering, and spoof you to the customer service agent, get access to your account that way. It's been done before, it'll be done a million times, and it's because, again, we insist on associating fucking our personal information to everything, and it's bullshit. It's fucking stupid, really. I mean, I consider it an aspect of security to lie to your cell phone provider. You shouldn't have to, but it helps. Lie to them. Say, I'm so-and-so. I'm Bill Clinton. Although that's probably not advisable. I think that's impersonating a federal official or former federal official. I think that's actually a crime. But anyway, just make up a fucking name, Rumpelstiltskin. Make up some other information and pay in a way that is not directly associated with you, your person. Such as dollars, or if they're willing to take it, cryptocurrency. But that's like your first level of defense, because if anybody ever gets your phone number and they try using your real information, they're not going to get anywhere with the customer service agent. They're going to go, who the fuck are you talking about? I don't have any customers by that name. Really, really simple. But it's a first level of protection. And when you're basing your entire financial life on your fucking phone number, on your address, so on and so forth, it becomes that much easier to associate all of your elements of data. And so as many breaks as you can possibly put in your security, where you're breaking the line of custody associated directly with you, the better. Because a lot of this stuff only works if you tell it the truth. If you lie to it, it fucks it all up and makes it work according to your benefit, not the benefit of the entities that are trying to exploit your identity and get a hold of your funds. Really simple, kids. Really simple. Got to take it to heart, though, because watching out for your own bunghole is the third axiom on this show, and I definitely consider that an important one. And as far as Vitalik's comments on IBM and IBM's whole stuff themselves, I think he's absolutely right that IBM is wasting their fucking time on the software end of things. They made this massive reputation over the last century of making absolutely fantastic hardware for enterprise class people. And of course, a little bit of consumer end stuff, but it's not as much a concentration of theirs. But it's like they already know how to make infrastructure hardware, right? Shit that doesn't burn out on you, or at least it takes a little bit longer to do so because it's a higher quality unit. Now, when you dedicate the type of knowledge and reputation that you've developed over the last century, and you apply it to hardware, suddenly the conversation can change vastly, where IBM can pick up a really big surface in the consumer hardware sector that's not terribly occupied at the moment. I mean, Samsung is in it, and a few other of the higher end entities are in it. But IBM already has the infrastructure to do it. And if they're not doing it already, I'd be really surprised. But their biggest concentration should be on hardware. They should be making miners, consumer grade fucking miners, upgradable consumer grade miners. I've already outlined my basic idea of how it should or could work, and a lot of the niche of hardware consumption that, or like the mentality that we have with regard to hardware consumption has already been established. Okay, we already know that no matter what we put on our desk, in another 2 years, another 3 years, you're going to be able to put something else on your desk that works twice as good, is twice as fast, is way better. We already know that. We're already conditioned to that mentality. We're also conditioned to the mentality of, in between now and say 5-10 years from now, when I do another hardware upgrade, I can add video cards to it. I can add audio cards to it. I can add a hard drive to it. I can add all kinds of peripherals to it. I'm already conditioned to think of hardware purchases in this way. So now take it to IBM, right? Where they put out a base unit. And they figure their time on your desk is roughly 2 to 5 years for the base unit. Right, depending on, of course, on the market and what goes, whether there's any major speed bumps or and when I say speed bumps, I mean bumps up in speed for the processors or whatever. They just get better at it, or they get better processors, But have these, or this aspect, or these attributes of the device upgradable, right? So maybe you get into mining with it, and you buy one for like, I don't know, $200. That's like your base unit or whatever. You plug a monitor into it, you set it up, you configure it with the mining pool that you're going to be with. You set it up for the coin that you want to mine with it, and then you let the thing fly, right? Now, imagine maybe you get really into mining. You're like, man, this is fucking awesome, so I'm going to buy another one. And another one. But maybe in like a year and a half, maybe in 2 years, IBM comes out with an upgrade module for it. And of course it's got slots on it that it can fit upgrade modules into. And so now instead of just having one base miner, you can plug in another miner, and another miner, and another miner on that box. And say it has like 3 to 5 bays. So like your base unit, it's got 3 bays in it, right? It's $200. Your next one up is $350. It's got 5 bays. The next one up from that is $500, and it's got 8 bays. But you kind of get what I'm saying here, or the kind of thing that I'm laying out is that we're already conditioned to think about hardware upgrades like this. We're already conditioned to think about our hardware purchases in 2 to 5 year intervals. So why fuck with that? Rather than jumping off the cliff of having 100 years of everybody praising your hardware and everybody happy with your hardware, and you become this fucking international megalith, rather than having established that and then just simply abandoning it and trying to jump into software end of things, why not leverage that hardware reputation, that know-how of making hardware? See, I think that's where IBM is misthinking things, and that's just according to my knowledge of IBM at this point. For all I know, they got some fucking building, and it's dedicated to nothing but developing prototype miners. But yeah, that as far as I'm aware, it's like, and we only know what they tell us, right? I was just talking about this with my dad the other day, that NVIDIA, the way that they downplayed their GPU purchases, it's actually, I think it's been negatively impacting their sales, and that, they like, I want to say about 2 years ago, right before the really big spike, people, they were buying up a shit ton of GPUs, and they were mining. And of course, they were pissing off gamers, from like, I want to say like 2012 to roughly 2018. Yeah, roughly there. Where they were pissing off the gamers because every time the gamers wanted to buy a video card, they're like $100 more than they want to pay, $200 more than they want to pay, $300 more than they want to pay, a lot more than they want to pay for a fucking GPU to play video games and make it render better, right? And they can't get them online, and they can't get them over at fucking what is that place? Best Buy, or Fry's or whatever hardware store that they normally pick their shit up at. But they can't get them just because the supply chain is being all sucked up by miners. Now, what's funny about that is that NVIDIA spent the entire time saying, oh yeah, miners buy a lot of our GPUs, but it's really not a really big sector of or it's not a significant amount of our sales, our annual sales. Well, we figured out really quick that they're full of shit, and that most of their growth over that period of time, between 2012 and 2018, when they've been downplaying it, the fact of the matter is most of their fucking growth was from cryptocurrency miners. And we figured that out as soon as the drop-off happened, the drought happened here, the bear market, whatever you want to call it. All of a sudden they're not selling GPUs like they were because a lot of people lost the capability to mine because it became unprofitable for them. And there they were holding their fucking dick on a stage saying, well, I guess mining did really make up a little bit more of our sales than we have been saying for the last 5 years, but we'll be fine next quarter. AI is going to pick it up. VR, AR is going to pick it up. We're not going to worry about it too much. Meanwhile, ASICs have dropped through the floor in cost, and to some extent, I think the additional interest that was drawn into GPU mining, such as Samsung and a few others, Intel, that's the new base of things, and I don't really expect GPU mining to go away anytime soon. I really don't. I think more and more it's going to end up in Bitcoin mining. That at some point the race that's going on between the bigger manufacturers now with regard to speed and capabilities and efficiency, that it's going to end up driving us through the next alt bloom, where we're going to see a point where there's certain people that were really dominant before, but for whatever reason they're still underwater on their initial investment, and then some new iteration of video card will come out, like the GPU nanometer standard will really go down to between 7 and 10 nanometers for everybody, and that's going to reshape hardware, period. That was one of the big problems of the alt bloom, was that the demand was causing NVIDIA and all these other companies to pull shit off of their R&D shelf and bring it onto production years before they had intended to. Well, that well isn't perpetual. You do drain it after a while. And so I think that their greed kind of caught up with them. And what's on the market right now is able to sustain the network demands of the cryptocurrencies that are out there and the ones that are being born. Between the initial market and the secondary market, that it's cheap enough hardware for people to actually get some use out of, some profitable use out of. And so between the lag in sales because of the secondary market, the lack of interest due to the bear market, I think that they're going to get stuck in a spot where they'll get supplanted by a cheaper, faster entity. Somebody who's able to take advantage of that little bump in speed when it does come along, whether it be in CPUs or GPUs or ASICs, that they'll be able to buy the hardware when certain entities are still underwater from their previous investment and are trying to mine it back right now. And we're going to see another Bitmain come up, another GHashIO come up, where they're representing like 30-40% of the network out there for Bitcoin, and at least that much, if not more, for altcoins. But yeah, so IBM might want to change your focus, stick with hardware. It's what you know, and it's what we know you for, and I think it's where you'll do the best in cryptocurrencies. That's just me. But speaking of big boys and getting into mining, this one is actually old, but I think it's timely for what we're talking about here, and it's not really all that old. And so here it is. It's on cryptoglobe.com. Intel receives patent for, quote, energy-efficient, high-performance Bitcoin mining. And this is by Justin Pope, December 1st, 2018. Intel, the world's largest semiconductor company behind Samsung, has procured a U.S. patent for an energy-efficient Bitcoin miner. Intel is one of the largest chip manufacturers in the world, bringing in $62.76 billion in revenue in 2017. The patent explains the entire mining process, then details how Intel plans to fix the, quote, high energy costs of Bitcoin mining. They recognize the, quote, power consumption of the needed hardware accelerators is the reoccurring cost for the Bitcoin mining, and it seems they're trying to use this patent to help save miners energy and costs. The patent details Intel's energy improvements and makes bold claims as to how much power consumption they could save. Quote, dedicated Bitcoin mining ASICs are used to implement multiple SHA-256 engines that may deliver a performance of thousands of hashes per second while consuming power of greater than 200 watts. Embodiments of the present disclosure employ microarchitectural optimizations, including selective hardwiring certain parameters in Bitcoin mining computation. The hardwiring of these parameters eliminate the need for recursive rounds of computations of these parameters and reduce the overall circuit area and power consumption by about 15%. Intel missing the point. Many competitors have pointed out that more efficient hardware will not impact Bitcoin energy usage. If the mining farms can afford $100,000 in energy, they'll use it all if they will increase their hash rate and make more money, whether that's on 100 miners or 150 efficient miners, Hazu on Twitter explains. Quote, excessive power consumption for Bitcoin mining has long been a criticism. You can't reduce the power consumption of the Bitcoin network by making better ASICs. Total money spent on energy stays the same because hash rate follows price, no matter how easy it is to produce the hash. He follows up his tweet by saying, quote, if Intel succeeds in making a Bitcoin miner that, quote, reduces power consumption by 15%, the result is that 15% more mining rigs come online, spending the exact amount of energy as before. Yeah, that's the end of the article. Yeah, I could see that point. However, you only have so much room. So maybe you can't really afford 50% more mining area. And also there's probably a cost differential because we are talking about Intel, where they'll probably be able to make the devices cheaper than, say, Bitmain or a few of the other smaller mining Antminer. Yeah, there you go, Antminer. Anyway, so yeah, their ideas for trying to reduce the energy consumption for mining, I think it's good, and I think with their ability to both produce and distribute hardware, I think that they could make themselves a very significant entity within the mining space. But again, it all depends on whether or not they can make good. And it's really the difference between a good coin and a bad coin, or a good miner and a bad miner. And making good, that's definitely the sticking point that a lot of people have trouble with, and probably the most trouble with. As a matter of fact, got this other article that I wanted to cover before we get into our music break. Let me hydrate really quick though. Much better. Anyway, this one's on medium.com. Squire Mining, which is CoinGeek BSV, runs into ASIC development issues. This one's a bit more modern. This is, or up to date rather, January 31st by Killer Cola. Clearly, yes, penis. Quote, Squire Mining Ltd. announced the resignation of Taras Kulik as Chief Executive Officer and Director. This was after initial simulation testing of its new prototype ASIC chip for mining Bitcoin BSV. The chip produced low-yield results that were inconsistent with design parameters that were sought after. Meaning that Fake Toshi probably badgered them until they said, yes, it can do it. And the whole time he was saying, no, you can't do it. And yeah, anyway, continuing on. Press release from Squire Mining. The latest news does not bode well for Squire Mining and Bitcoin BSV. The failure to launch their own ASIC chips will be seen as a massive disappointment, as they were being developed to help secure the BSV network with more hash power. It should be noted that these types of issues are commonplace in the computer chip industry, with Intel facing similar issues last year with their own 10nm process. It seems that running an ASIC mining chip company isn't as easy as Calvin and Craig Wright, major proponents of Bitcoin BSV, had initially anticipated. The reported purchase of CoinGeek by the Canadian ASIC developer Squire Mining for $45 million, what is essentially a reverse merger for a publicly traded company. This could potentially give them an opportunity for market manipulation, something we should all keep a very stern eye on. Release bad news and the price tanks. Release good news and the price of the public shares rises, something which the SEC would not take kindly to. Squire Mining, after reaching an all-time high of 85.5 cents Canadian, that is, on September 20th, 2018, reached its lowest point today, February 1st, with a close of 1.8 cents, falling 79.1% since September. Reporting of Squire Mining's financial can be found here, although it should be noted Q4 has not been updated. Cause for concern? Sarcasm. According to the report for the 6 months ended April 30th, 2018, quote, the company has not generated revenue from operations and incurred a net loss of $1,189,391 for the period ended April 30th, 2018, has accumulated a deficit at April 30th, 2018 of $1,678,765 and expects to incur further losses in the development of its business. See, see page 8 of the report here, which begs the question, how does a company buy CoinGeek if it's not generating income? About Squire Mining Ltd. Squire Mining is a Canadian-based publicly traded company which reportedly purchased CoinGeek in December, are in the business of developing and operating data mining infrastructure to support global blockchain applications in the cryptocurrency mining space, including application-specific integrated circuit chips and next-generation mining rigs to mine Bitcoin SV, Bitcoin Core, and other associated SHA-256 derived cryptocurrencies. CoinGeek were recently involved in the major Bitcoin Cash fiasco / mining war, providing hash power for the Bitcoin SV project, which was declared the loser by most crypto outlets. It has been said that Squire Mining were originally a physical mining company, but I couldn't find any sources on this claim. Edit. I have been provided with sources for the above statement. Squire Mining was a mineral mining company pre-2017. Ah, interesting. More to come. Events are unfolding with more sources to be found. Yeah. So there you have it. Thank you, Killer Cola. This is really interesting. I mean, every time I even look into anything that's associated with Craig Wright, I find some element of that could be discerned as fraudulent activity, or could be determined to be fraudulent activity. Now, this is not to cast any dispersions on anything the man is involved with, such as Bitcoin SV or anything like that, because there's a lot of good people that are behind the projects. Whether or not we think they're devoting their time appropriately, that's not really for us to say. Certainly not for me. I mean, I think any time that you really spend dedicated to not trying to defraud people, but actually provide the service that you say you're going to provide, and do it in the way that you say that you're going to do it, keep going, man. I don't think that's wasted time at all. But whether or not the project that you're dedicating your time to and effort to will actually fulfill on the goals that have been set for it, that's a whole different thing. I read some tweet, I can't remember where it was, but the guy seemed to be implying that the entire internet is going to be hosted on the Bitcoin SV blockchain. Now, people don't usually make those kind of claims just to make those kind of claims. It's usually because somebody stuffed that bullshit in their ear. And so I'm like, what, you're going to be the new ISP or something like that? What kind of bullshit is this? And it's funny to me that people keep buying this shit. You know what I mean? And I'm not talking about BSV or anything like that. I think it's an entity into and of itself at this point. Whether it'll actually do all of the things that CSW and CoinGeek and others have promised, that's an entirely different thing. And honestly, I'm dubious, because it seems like every claim they make is some inflated bullshit. It's like they had this big spike in their hash rate on the network. Well, it turns out it was rented. And it's like, what the fuck are you trying to tell me here, man? That you can rent hardware? I mean, it's not that everybody loves your shit and is dedicating hardware on their own, of their own volition, which, that's kind of what drives cryptocurrency projects, is participation of the public. If people that aren't paid by you feel compelled to participate in your project, it's probably because you're actually trying to fulfill on your goals. If you have to pay them to simulate that, chances are you're a fraudulent bastard and you're trying to fool the rest of the market. But make no mistake, we're talking about our money as well as your money. So, with our money, it's within our interest to make sure that you're actually delivering what you say you're delivering. And if you are failing to deliver that, you do not deserve our money. Thank you. Good night. Actually, I'm not closing it out there, but I am going to jump over to some music. Anyway, yeah, I'm feeling the need for some prong, but I'm so put off by that tendency of people. But again, we are talking about money, so people trying to get the money for free. That's like time immemorial right there. Let's go ahead and throw it down. I got Inner Being by Prong here on Coin Metal. And that was Doyle with Abominator. Yeah. I'm really digging on the Doyle, man. It's good stuff. Tasty. Anywho, let's get back into it. And I got a few articles here that I wanted to bring up. And, with all what we've been talking about with regard to, misplaced priorities, and of course some missteps, mistakes, missed deadlines, missed expectations. These all result in a poor reflection in the market. Now, of course, if you've been around since, say, the late 90s or mid to late 90s, you remember the .com bubble. You also remember the Linux bubble. It's not really talked about, but there was a shit ton of money thrown at Linux when Red Hat went public. Like, Red Hat went public, and then like 30 different variants of Linux came out. And a lot of them were trying to, say that, we're making computers that are, way more efficient for using Linux on than a bunch of bullshit. But this cycle, it's repetitive. And if you've been around it enough times, you kind of see how it's developing and why. Whereas with Linux, it was just the thing of, oh, hey, there's this new thing. It's a competitor for Microsoft for disk space. Let's get in on it. And if you look around you, Linux is pretty much taken over everything. I mean, with the exception of like the front end of your Windows or Mac OS, it's pretty much all Linux. And so, it shouldn't surprise you to see a lack of trust as a reflection of those ups and downs with regard to blockchain companies and Bitcoin projects and cryptocurrency projects and hardware projects, so on and so forth. And here we go. This one's on bitcoinnews.com, and this is for Saturday, February 2nd. So apparently this was a time traveler, no indication of who actually wrote it. Although the Bitcoin News tends to be an aggregator site, so let's just make sure this wasn't just an aggregated... Wait a minute, there it is. Yeah. As I expected, it is aggregated from another website, and of course they don't bother to make it a fucking hyperlink that you just click. No, you gotta do some fancy shit. So anyway, this one's on don't allow globalcoinreport.com. Blockchain Defender reports on a lack of trust in the crypto industry. And this is published 22 minutes ago, February 2nd, 2019, by GlobalCoin. The cryptocurrency industry reached its peak market capitalization in January 2018, nearly reaching $800 billion. However, even with such a large market capitalization, the market faces a lack of trust. Blockchain Defender recently released a report examining this lack of trust. Questions answered in the report. Within the report, Blockchain Defender clearly outlines its goals. The first question to answer lines up with the title of the report, and asks how market sentiment affects the market capitalization of a cryptocurrency. The report also aims to determine which digital currencies have the best and worst online reputations, spot various variations in digital currencies' reputations by countries, and see where the online negativity most frequently gets published. The second section of the report compares the online reputation of traditional trading exchanges with crypto exchanges, and the final section explores the impact of a crisis on a cryptocurrency's price. Market Sentiment, Trends, and Capitalization, Study 1. The first study of the Blockchain Defender report begins by confirming that the number of searches for cryptocurrency and online sentiment regarding digital currencies correlate with the global market capitalization of the crypto market. This is confirmed via ups and downs in all values from January 2017 to July 2018, all clearly displayed on an easy-to-read graph. To examine differences in online sentiment towards cryptocurrency in various countries, Blockchain Defender used search results and analysis in each country's native language. The study involved 4 countries. The results indicate that the most negative search results were found in the US, followed by Germany, the United Arab Emirates, and Japan. Sources of negativity include social media platforms, blogs, crypto industry news websites, discussion forums, crypto review websites, and crypto company directories and websites. In a specific analysis of Bitcoin's online reputation, Block Defender found that the United Arab Emirates had the most positive search results of the previously mentioned 4 countries. The United States has the most negative search results. In an overall global analysis of online sentiment towards dozens of digital currencies, Blockchain Defender reports that Economy performed the best and Bitcoin Cash performed the worst. You know what? A lot of that was fucking astroturfing too, so I don't really care about that. Comparisons with traditional exchanges, Study 2. The second study focuses on a comparison of traditional exchanges with cryptocurrency exchanges and discovers that the former has much more control over its online sentiment than the latter. Blockchain Defender outlines that a significant factor is the level of content ownership, since traditional exchanges own 0.38% of content, while crypto exchanges only 17.75%, that is. Impact of a crisis, Study 3. The final study looks at data for cryptocurrency that experienced a hacking crisis in 2018, both before and after the crisis. In the West and overall, the crypto experienced a significant drop in positive content and an increase in negative content. To view the Cryptocurrency Trust Report on SlideShare or download, click ebook version. Ooh, we might just do that. Let's see how big this fucking thing is. No, I don't want to. No. Let's go on SlideShare. Well, it's 19 pages, so I think we can get through it. Let's go for it. And give it a little plus here. In overall plus. Yeah. That a couple more times. Let's do it. How lack of trust affects the global market of capitalization of the cryptocurrency industry. Executive summary. Oh, let's see here. Go with this way. There we go. Executive summary. Blockchain is a technology synonymous with transparency, traceability, and trust. However, does trust really exist from the perspective of an outside observer looking into the blockchain industry? Can protocols built upon trust truly evolve without first gaining public trust? I think you're a little wrong there. Anyway, and an overview of the market. It takes 20 years to build a reputation and 5 minutes to ruin it, said billionaire investor Warren Buffett. Quote, if you think about that, you'll do things differently. Bitcoin and other digital currencies have only been around for 10 years, yet despite their checkered and often negative reputation, volatile and opaque according to some critics, they've grown fast. And those critics would be completely wrong, man. There's not really too much that's quote-unquote opaque about cryptocurrencies. Maybe about some of the people involved in it, but not they themselves. Continuing. In early January 2018, the cryptocurrency market reached a peak market capitalization of nearly $800 billion. There are now more than 2,000 cryptocurrencies, including Bitcoin, Ethereum, and Litecoin, according to CoinMarketCap, which are traded by millions of people on over 200 exchanges. Experts predict that a small number of select cryptocurrencies will eventually become globally adopted, replacing traditional government-backed fiat currencies. Not bad for a new and unregulated financial asset. Yet 2018 has been a bad year for digital currencies, which have lost 3/4 of their value since the peak at the start of 2018. Initially, the fall was attributed to South Korea's government suggesting that it planned new regulations for cryptocurrency trading. However, as time passed, it has become more apparent that the fall cannot be attributed to any one factor. Politicians have likened the cryptocurrency industry to the Wild West and said that it should be regulated to protect the public. Protect the public from who? We are the market. What the fuck? In September 2018, the global market capitalization of cryptocurrencies fell further after media reports that Wall Street financial institutions, including Goldman Sachs, were shunning cryptocurrencies. Yet despite persistent concerns about the long and medium-term future of digital currencies, relatively little is known about the link between their online reputation and their financial value. It's because you're not mining, that's why. In this report, Reputation Defender will aim to answer the following questions. Number 1, how does market sentiment, the proportion of news comments about digital currencies in the Google search results that are positive or negative, affect a cryptocurrency's market capitalization? Number 2, which established digital currencies have the most positive online reputations and which ones have the worst? Number 3, how does the online reputation of digital currencies vary by country or region? Is the sentiment surrounding digital currencies more negative or positive in different countries? Number 4, what types of website is negatively most commonly published to? Number 5, how does the online reputation of digital currencies compare to an established financial asset / market, such as traditional exchange markets? Number 6, what impact does a crisis have on the price of a cryptocurrency? Closing summary. Finally, why does the cryptocurrency industry have a bad reputation, and how can cryptocurrencies combat this problem? More people can get involved, that's why. Or how. The impact of global search results. Google search results, my apologies. So how does the prominence of content about a cryptocurrency or crypto exchange in the Google search results affect its reputation? The higher a website ranks in the Google search results, the more clicks it will get, and the more potential investors will read about it. Our research analyzes how users interact and form opinions on the information they find via a Google search for a cryptocurrency. In the online reputation industry, it's widely accepted that 75% of search engine users will choose whether or not to engage with a brand, product, or service based on the search results shown. However, this percentage is likely to increase for digital and online services due to a lack of offline material. Therefore, if 1,000 investors read negative content about a cryptocurrency, wallet, or exchange, we can safely assume that 75% of them will choose not to invest. Also, it's important to remember that a lack of positive search results has the potential to be just as damaging as negative search results. This knowledge helped us measure each cryptocurrency's online reputation and compare it to their financial performance market cap. At a time when digital currencies are under growing scrutiny, how they manage their online reputation can affect their growth and whether they attract enough external investment. Yeah, external investment becomes internal investment, dude. That's how this works. Market trend, market sentiment, and market capitalization. Reputation Defender has conducted extensive research into the online reputation of thousands of digital currencies, including Bitcoin, Ethereum, and Litecoin, in 4 countries: the United States, Germany, Japan, and the United Arab Emirates. These countries were chosen because they have large and growing cryptocurrency markets, and because Reputation Defender services blockchain clients in these countries. A team at Reputation Defender used its expertise to analyze and quantify online sentiment about digital currencies and track any connection with their financial performance. First, Reputation Defender calculated the total search volume for cryptocurrencies based on Google AdWords data. Then, using predetermined criteria, online mentions of each crypto-based brand were categorized into positive, neutral, and negative categories. 2 pages, positions 1 through 20 of Google search results about each cryptocurrency were analyzed in the research. Negative online content included keywords such as hack, scam, and Ponzi when they were used in articles about a cryptocurrency. Other types of negative content can include abusive comments about a cryptocurrency in an online forum or the comment section of a news article or on a company's Wikipedia page. Positive content included words and phrases such as ICO, initial coin offering, ROI, return on investment, or ROI, sound investment, and milestone. This market sentiment was then cross-referenced with market capitalization of digital currencies. The results of our analysis. The graph below shows the digital currency market between the 1st of January 2017 and the 31st of July 2018. And gosh, it follows along the price chart here. Oh, let's see here. The graph tracks 3 metrics. Number 1, the blue columns shows Google's trend data, the anonymization data showing how often people search for the term cryptocurrency. Number 2, the orange line shows sentiment about digital currencies, whether online content about digital currencies was positive or negative. The red line shows the market capitalization for the digital currency market. The first section on the left of the graph shows 3 things happening simultaneously. Number 1, Google searches for digital currencies became more common, shown in Google's trend data. Number 2, positive online sentiment about cryptocurrencies increased. Number 3, the global cryptocurrency market cap increased. In the second section of the graph, between September 17th and September 2017 and December 2017, this trend continued. However, between January 2018 and March 2018, the opposite occurred. The search volume declined, and online sentiment about digital currencies became much more negative. The market entered a bearish trend, and market capitalization fell sharply as a result. In the final phase between April and July 2018, all three factors, trend data, sentiment, and market capitalization, stabilized and plateaued. An increase or decrease in the search volume of cryptocurrencies and whether online sentiment about them is positive or negative directly correlates with market capitalization. By analyzing a cryptocurrency's online reputation, investors may be able to better predict its future financial performance. Key research findings. Number 1. There's a clear correlation between an increase in negative online sentiment about cryptocurrencies and a fall in their market capitalization. Number 2. If there's high search volume and positive sentiment, a cryptocurrency's market capitalization increases. Number 3. If there's negative sentiment about a cryptocurrency that becomes more prominent, market capitalization decreases. Crypto reputation by country. Our research analyzed online sentiment surrounding digital currencies, whether coverage is positive or negative, in 4 countries: the United States, Germany, the Arab Emirates, and Japan. Reputation Defender carried out this analysis using the native language of each country: English, USA, German, Germany, etc. As you can see from the graph below, there were significant differences in sentiment between countries surveyed. And let's see here. USA is 55, Germany is 48, United Arab Emirates is 29, and Japan 26. I'm assuming that's like references per 100 or some. It doesn't give us an actual table there. Sources of negativity. The most common online destinations Reputation Defender found for online negativity towards cryptocurrencies were cryptocurrency industry news websites. Number 2, social media platforms and blogs. Number 3, discussion forums, ergo, Reddit, and Bitcoin Talk. Number 4, cryptocurrency review websites. Number 5, cryptocurrency company websites and directories. Bitcoin's global reputation. Reputation Defender analyzed online sentiment towards Bitcoin in the US, Germany, Japan, and the UAE. The UAE had the most positive search results for Bitcoin, followed by Germany, the US, and Japan. The US had the most negative search results, followed by Germany, the UAE, and Japan. And let's see, good graphs. Leaderboards, best and worst performers. Oh, wow. Let's see. I don't see Verge. And best performers. Oh, wow. Tether was actually in the positive range on here, which is surprising to me at least. Same thing with Ripple. They must have like known the words to add to their stuff. Oh, but wait, Tether is actually 89% on the negative side. Woo. Well, geez. I didn't even see Verge in here. That's weird. Anyway, continuing on. Positive economy, highest number of positives. Positive split by count. crypto market, social media, blog, blah, blah. Bunch of charts. Reputation matters. Crypto exchanges versus traditional trading exchanges. If an exchange isn't trusted and respected, traders will often choose to use a competing exchange. Coins listed solely on these exchanges will potentially inherit this negative sentiment and could therefore underperform at crucial stages in their development. Traders have increasing options and new exchanges are appearing daily. The crypto exchanges aren't only in competition with each other either. They also compete with more established traditional financial exchanges and trusted trading platforms. Reputation defenders studied and compared the online reputations of 10 cryptocurrency exchanges and 10 traditional exchanges in 4 countries: the US, Germany, Japan, and the UAE. Our research found that there was far more negative content in the Google search results about crypto exchanges than traditional exchanges. Traditional exchanges, solid reputations, well managed. Traditional exchanges have more control over their online reputation. They also have more inside information based on about what kind of search results to yield the best results. This control is largely driven by positive ownership, such as official exchange websites and social media channels. Over 1/3, 34.38% of the content is officially owned. Our analysis also shows that traditional exchanges benefit from a healthy volume of positive commentary from third-party websites. Nearly 30% of all online content we studied can be categorized as positive in sentiment. In comparison, crypto exchanges seem to be struggling to protect and improve their online reputations. A major contributing factor to this is the additional channels of negativity which traditional exchanges do not suffer from, such as social media, blogs, and pricing websites. This lack of control has resulted in potential investors and customers being faced with 275% more negative coverage about crypto exchanges than they would about traditional exchanges. In addition, crypto exchange ownership of search results was just 17.75%, which is nearly half of traditional exchanges. Where is most of the negative sentiment coming from? Probably banks. For traditional exchanges, just over 51% of negativity comes from review websites, which is typical for a consumer industry. Negative content about crypto exchanges comes from far more sources than negative content about traditional exchanges. Crypto industry websites account for about 1/4 of negative search results, followed closely by blogs, forums, and social media channels, which together account for 23% of overall negative content. In some ways, crypto exchanges have become a victim of their own success. Their rapid growth and excitement about their future means that they are subject to far more scrutiny from bloggers, crypto enthusiasts, and the media than the traditional market is. Of course, and plus we're new. Not as many people are as experienced with this, and so they have to rely on a lot of anecdotal data, which for the most part has been astroturfed and fudded to hell. But continuing. Case study, a crypto in crisis. Reputation Defender analyzed the online reputation of a cryptocurrency which faced crisis in 2018 after it was hacked. Our research was based on a before and after crisis analysis of the brand search term in 5 countries: the US, the United Kingdom, Japan, the UAE, and Germany. Before crisis. Before the digital currencies crisis, there was little to no negative content, 1.3%, published about it in the 5 countries we analyzed. In fact, the cryptocurrency in question had one of the better online reputations within the industry. The amount of positive content shared online about the company, 16.4%, was significantly better than the industry average. After crisis. Immediately after the crisis was made public, there was a big increase in negative sentiment, up 22.1%, about the company in 5 countries. At the same time, positive content about the digital currency decreased by 14%. East versus West. Interestingly, there was a significant difference in how the crisis was perceived in different parts of the world. There was a huge swing in negative sentiment about the cryptocurrency in the West compared to the East. Negative news sources. We analyzed the search results for the digital currency in question before and after the crisis. The charts below break down and categorize the sentiment of the sites in the search results. In 1 week, we can see how positive search engine ownership decreased from 22% to just 3%. On the other hand, negative search engine ownership increased dramatically from 2% to 28%. Wow. I really want to know what this coin is. By breaking down negative search engine ownership, we can see that 20% of negative sites have been categorized as crypto market news, ergo cryptocompare.com. 5% of negative sites have been categorized as mainstream news, ergo bloomberg.com. 3% of negative sites have been categorized as forums, reddit.com. The combined average search volume for the brand was 250,000 searches per month. The increase in negative content about the brand may have deterred as many as 65,000 potential engagements. Coin price during the crisis. How did the crisis affect the coin's trading price? Our analysis of the week during the crisis shows the devastating effect a crisis can have on the market value and share price of a digital currency. The coin price fell sharply overnight by about 1/3 during the week, resulting in the loss of tens of millions of dollars from the company's value. And let's see, they start off at $3 and they're down to about $2, so that gives us a little better idea of who it was. Before crisis, market cap was $160,313,254. Price in USD was $3.20. After crisis, market cap $104,760,132. Price in USD was $2.05. So that was a $1.15 divot in their ass. Closing statement. As a result of Reputation Defender's research, it is clear that potential professional investors and the public are researching blockchains, cryptocurrencies, and tokens online. They're making investment and adoption decisions based on what they find. Why does the blockchain industry have reputation issues? The blockchain industry has earned a bad reputation as a result of the numerous scams, hacks, and shady characters operating within it. There is a contentious spread of misinformation, commonly referred to in the space as fear, uncertainty, and doubt, FUD. This has resulted in a severe lack of trust. That's the way it should be, by the way. We're not about trust here, we're about verifying. The industry has been tarnished by the very problems it sought to eradicate in the world of finance, and as a result, the public has been burnt. It is essential that investors regain confidence to achieve mainstream adoption. Yeah, the way to do that is by using it and mining it and so on and so forth. How can cryptocurrencies combat reputation issues? It is critical for cryptocurrencies to focus on building a credible and durable online reputation. A shift in reputation sentiment or a PR crisis which damages your brand online can devastate the price of a coin the price a coin is trading at and deter adoption. Engagement. Blockchain projects pride themselves on being community-driven and funded. For this reason, it is essential that community members feel like they are active participants of the project and that their voices are heard. To achieve this, any respectable blockchain project should have a clear and robust social media strategy that interacts and engages with its audience. We do that in spades. Global approach. The majority of blockchain projects aim to be adopted internationally. A key part of this is to interact with the target audience in their native language, adhering to cultural practices and differences. 85% of search engine users expect to see information in their own language before deciding whether or not to engage with a brand. Being heard for the right reasons. Due to the prolonged bear market, many blockchain projects have halted or slowed down their marketing efforts. Doing this can be extremely detrimental to the success of a project and can lead to the collapse of a coin. Cryptocurrencies must broadcast their news, updates, and progress in a clear and concise manner to authoritative and trusted industry websites. This not only helps to cement and maintain a positive reputation for the project, it also makes it stand out from the competition as a respectable project with a long-term vision. Blockchain Defender by Reputation Defender. Blockchain Defender is a new product offering from Reputation Defender that offers tailored reputation management solution for cryptocurrency. This has all been a big sales pitch. That's funny, dude. Yeah, fuck you. It's funny that he mentions the importance of community, right? And then he's talking about the possibility here of creating your community for you, or at least maintaining your reputation within your community. And I'm sorry, guy. Pascal, yeah, that's the name and founder of Future of Trust. Yeah, fuck your trust, man. Look, the reason why we exist is because of trust. And it's the capability to verify that differentiates us from traditional markets. And yes, that does mean that sometimes we eat shit based on our own metrics. Metrics that are defined by the market itself, by actual market performance, not just reputation. And it's one of the places where if the traditional finance market really played on an even playing field with us, they would find their own reputations lacking. I mean, there isn't a month that goes by I don't see something about like Wells Fargo or fucking Chase Manhattan or Goldman Sachs or one of these people, one of these industry players in the legacy finance industry who has defrauded thousands, if not millions, of customers in a wide variety of ways. And it is due to trust. And you, Mr. Monkey Boy Pascal, aren't really helping anybody by manipulating the social surface of a cryptocurrency's reputation. You really aren't. You're probably going to end up taking some money to game up the reputation of a shitcoin, scam coin, and because nobody can see it coming, because you've tailored up their Google search engine results. Because nobody can see it coming, they lose a shit ton of money. And they are going to be coming to you because they find out that you're the one managing the public surface of this company or cryptocurrency. You're going to be wearing the fucking dent, that you're whining about in people's pocketbook. Yeah, I think this is one of those places where like the traditional finance sector created a lot of bad habits. I mean, if you watch The Big Short, please watch that movie. It's fantastic. It's not only entertaining, it is fucking educational. Okay? One of the principal characters in it had a goddamn congressional meeting where it was put on fucking C-SPAN, where he's like, dude, I told these guys this is bullshit. Anyway, point being that, it's a very good look into the catalyst for the creation of cryptocurrencies, that we wouldn't even exist if the trust in fiat currencies and legacy finance was left inviolate. But they went and harpooned themselves with their extravagance. And that's not our fault. It's like, if you really want to get serious about reputation, go back to 2007, okay? And then scale out to 2018, and then look and compare it at how we shore up against legacy finance. I can guarantee you there is some animal on this planet that puts out turds that have a better reputation than legacy finance if you go back to 2017 and scale forward to 2019 or 2018 even. And that's one of the reasons I find this analysis at least a little bit insulting and a tiny bit disingenuous, because it assumes that the whole reputation span has just been within the lives of cryptocurrencies. If you're going to compare us to the industry that we're trying to supplant, you got to include their bad deeds too. The negative sentiment and whatnot. I would guess, according to even this information provided, that a lot of the social media is curated. A lot of the news articles are curated by the companies in question, because these are big trillion-dollar fucking companies. They can afford to do that. And they can afford to bribe people like Mr. Pascal here to put out false signals. So when the SEC is reviewing all the social media data, and when the SEC is looking at Google search results, they're not seeing anything about, fucking Wachovia just laundering $380 billion worth of cocaine funds. It's really sad that people haven't really learned. They haven't really learned. The saving grace with cryptocurrencies is that the public mines them. If the public didn't mine them, we would have that much less sensitivity to what the market is actually doing. That's one of the reasons why I'm really against any of this off-chain bullshit, because you're trying to take that traffic and put it off into an opaque zone that it doesn't need to be in. As a matter of fact, it was designed specifically to eliminate. Anyway, let's go ahead and throw back down into some music. I have ranted on and on and on and on, and I know some of you guys just love my voice and love my perspective, and that's why you're here. But we do play music too, so we're going to have to do that. And as far as what to play though, I really like this song by Skindred, Machine, here on Coin Metal. And that was Anthrax with Time. Man, that whole album is fucking awesome, by the way. But it is with that we got to close it out, because it is that time, kids. Got about 3 minutes left here. But we will be back again on Monday at 8 p.m. Pacific Standard Time. So until then, I'd like you all to trade safe. Do your homework. And watch out for your own bunghole, because nobody's going to do it for you. Thank you very, very much for listening. I certainly do appreciate the support. Like I said, we'll be back again on Monday at 8 p.m. Pacific Standard Time. So until then, you all have an excellent weekend. And as far as our last dance, I'm tempted to push it just a teeny tiny over just so I can fit a little bit longer song in. But I might just have to default to bounce. I think it's time. We haven't played that one for a long time. So, where is it? Scroll. There it is. Bounce by System of a Down. Last Dance here on Coin Metal. Thank you again for listening, and good night.